So this is definitely going to be a different style of video. In this video, we're going to be listening to some warnings we heard today on the US economy. Some individuals expect we could be in a full-on recession by the end of this year. We're going to go over some of the data points surrounding this. I'm going to make my argument to whether or not I do think a recession is coming. And then I'm going to show you 4 stocks that I currently have positions on. I'm going to show you my position size and how many shares I own and what my expectations are. These are stocks that have gotten beaten down that have the potential to 3 to 20x or more in value. These are not your Metas, your Teslas, your Apples, your Microsofts. These could have the next 12 months some hundreds of percents in gains, and they're not what you might think. They're not super risky stocks, and all of them have actually been growing more than Apple, Microsoft, Google, Amazon, minus Tesla. Tesla has been growing more than some of these companies, but nonetheless, these companies have been doing fantastic. The last couple of years have treated them well, not their share price. So let's go ahead and get into it. These are stocks that I have been buying recently. If we get a pullback in the markets in which a lot of people are starting to expect, these stocks could get even more attractive, and you could be looking at a 30-40x over the next coming years.
Majority of U.S. adults feel the current economic environment is having a negative impact on their finances. That's according to a new exclusive CNBC Morning Consult survey. Middle-income households are feeling the negative effects the most, sentiment that has held steady since our first survey in June. Higher-income households say they're feeling the effects less than 3 months ago. And sentiment among top earners is shifting. 30% now say the economy is having a positive impact on their finances. That's up from 21% in June. Still, almost everyone, 92%, told us they have cut back on spending over the last 6 months. Clothing, restaurants, bars, and entertainment remain the most common categories for cuts. Looking ahead, more than 3/4 of consumers say they will cut spending on non-essentials sometimes or more often over the next 6 months. We will continue to watch this closely as we get into the all-important holiday shopping season. Interesting the way we're getting some splinterization on income brackets.
Also, I thought it was interesting that restaurants were included there because none of it surprises me on goods. We know that's been softer, and that's not where consumers are spending after they spent so much on COVID. But services is what has stayed hot and sticky. So deceleration there is notable, I think, for the Fed's inflation fight.
And an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but maybe
it may start in 2023.
The Federal Reserve recently said that they think we've cleared the recession hurdle, and they don't really project a recession any longer. Do you disagree with the Fed on that?
Yeah, I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the great bubbles. They prided themselves in stimulating the bubbles. They took credit for the beneficial effect of higher asset prices on the economy. They have never claimed credit for the deflationary effect of asset prices breaking, and they always do.
So the first thing we're going to look at is this from AI.com. This tracks investor sentiment. Now, what you will find is the actual percentage of individuals that are bearish has actually went down from August 23rd was actually the week that we had the highest amount of bearish investors at 35.9%. Today, you were at 29.2%, and this is actually down from last week's number of 29.6%. The bullish amount of investors is basically unchanged from this same period in August 23rd, the week of August 23rd, 2023. What's actually changing the most is the amount of individuals that are neutral, neither bullish, neither bearish. This is interesting. The 1-year bearish high is 60.9%. The 1-year neutral high was 39.9%. The neutral level today is 36.4%. And the 1-year bullish high at 51.4%. So you're very neutral right now. That is what is winning. So I think the markets are really vulnerable kind of for this downside surprise. And why I think that is because the amount of bearish individuals is lower than it has been in over a month. This is not really concurrent with what we're seeing right now in the markets. Markets have been trending to the downside. Also, to the point of that individual we just watched the long clip on, he says, look to the bond market. Now, what the bond market will tell you, if you look back throughout the history of yield curve inversions, whether it's the 2-year and the 10-year or the 3-month and the 10-year, the same thing is true every time. Every time you have went inverted, so basically under this black line, you have seen a recession. Now, you usually don't see the actual drop or weakness in the markets until you uninvert, or at least bottom out and start to uninvert. And every time you start to uninvert, you uninvert pretty quickly right before you head into an actual recession. Even back in 2019, you briefly inverted, and then you uninverted pretty quickly and went into the Rona recession just 3 months later. Sometimes it happens even quicker than that. Sometimes it's a month between when you start to uninvert and you go into an actual recession. So what has happened recently is you've obviously been very inverted and you have started to see a uninversion. That is usually when the pain in the markets does start. Now, if you look at the 10-year and the 3-month yield curve inversion, this is the one that I like the most. You could see the same thing. Every time you've been inverted in history, you have went into a recession afterwards. So if you're betting there's a soft landing and no recession, you're betting that this chart is going to be wrong for the first time ever. And the 10-year and the 3-month was inverted the most it's ever been. It's still inverted the most it's ever been. The most you were inverted was back here in May of 2023, and this was inverted 1.88%. You have really started to uninvert here with the 10 and the 3-month. Now, same story here, but a little bit more aggressive. Usually, right before that recession, you start to get a big uninversion, and that's where the pain in the markets tends to actually happen. So we've already started to see that. If you also look at this chart of the personal savings rate from 1959 until today, you will notice a trend in which when there's more fear in the economy, when there's harder times for individual citizens, you tend to get a higher personal savings rate. But what's actually interesting the most to me is when the personal savings rate is the lowest is obviously when people have a lot of money and they're spending. But it's usually not when you see inflation. Usually when you see inflation, the personal savings rate is actually, pretty high. Well, what you've seen recently, and you can see this pretty well if you look at 05. 05, the personal savings rate was 2.1%. People were spending a lot of money. There was basically no inflation during this time, or right at about trend inflation. Nothing like we have seen in the last couple of years. Well, look at now, the personal savings rate is at 3.5%, but you have seen really high inflation. The question I want to ask you is do you think individuals are just not saving money because they're not fearful on the economy and they're just spending like crazy still? Or do you think individuals are not saving money because the cost of living is so high you cannot afford to save money? That would be my argument. And I think it's pretty clear for everyone watching this video, people are not saving money because they don't have the money to save, because inflation has been insane. Have you gotten your insurance bill lately? That sucker's up 35 to 60% depending on certain factors. Have you looked at your energy bill? Your even water bill is up 30 to 50% just in the course of a couple years. You can't get a 20-piece chicken nugget meal for less than $9 at McDonald's. That was $5 2 years ago. Just simple things like that. Just the cost of living is a lot more than what it used to be. And sure, you might have gotten a, $2 to $5 raise in the last couple of years, but it nowhere near compensates for the amount of inflation that you have seen in everyday living. So that's my argument. So I don't think with any of this, it's good. I don't think you avoid a recession. I do think a recession is coming. Question is, how deep is it? What different factors play into that? Well, that's obviously a different story. Even auto loan delinquency rates are at 3.9% of outstanding auto debt is at least 90 days late. So basically you're repoed on at that point, down from 5.3% during the high of the great financial crisis. That was when unemployment was 10%. 10%. Well, technically, I think it was like 9%. So let's extrapolate the data. Today, your unemployment rate is 3.8%. Roughly, let's call it 2.5 times more. Well, if your auto delinquency rate is 3.9%, well, times that by 2.5%, well, and you are substantially higher than where you were during the Great Financial Crisis. That would be equivalent on an unemployment basis of 9.75% auto delinquencies if the unemployment rate was where it was during the Great Financial Crisis. That's almost exactly half of the delinquency rate at the peak of the Great Financial Crisis. People are struggling. Pound for pound, people are struggling. They have jobs, but they are struggling. This does not end well. Okay, now what are the 4 stocks that I'm looking at and specific reasons on why I like them? Number 1, and these are not in like chronological order of what I like the most or biggest position size, but I think I do like Fubo the most. Now, I like them all a lot, so it's hard to really say. But Fubo, I think, is very attractive because it's a small cap. It should be going profitable at some point in 2024. And the growth you have seen with Fubo has been insane. And this Disney Spectrum debacle that you've seen over the last, month or so that looks like has now come to an end. Well, Fubo's Google trend data looks really good. It's at the highest it's ever been at. You're starting the NFL season. You've recently started that. And there's a lot of individuals that look at Fubo as really the premier sports network. And I do think just the simple fact of it is the valuation is very low. Fubo is trading at some ridiculous valuations here. You're trading at like a 1 for price to sales ratio on a company that is growing dramatically. Fubo is growing upwards of 30% every year, and that doesn't look like it's going to stop anytime soon. Fubo has about 1 million paid subscribers, a little bit over that, give or take, and they could easily reach 10, 20, 30, 40, 50 million in due time, so there could be some big upside to this one. Now, I do own Fubo in a couple other portfolios, but I currently have 2,350 shares of Fubo. It's 16.28% of this portfolio. Average cost of $2.42. Market value of $6,370. With a total return of about 12%. So this is one that's obviously going to be pretty volatile. I think this upcoming earnings is going to be pretty good, but it's definitely one of those stocks that can have 10+% drops on bad days in the market. So I do expect bad days to come, and Fubo could get a lot cheaper. At one point, this stock was $1 and some change. Okay, $1.10. So it's up 100% from there, but I still think longer term, Fubo is probably the one that could give you the best return. It's an $800 million company. I look at it as one of those worst case scenarios. You get a buyout probably at $1 billion or $2 billion. That's what I would expect. That's possible. They don't have a lot of debt. They are unprofitable, like I said, but that should be changing in 2024. So worst case scenario, you probably get a buyout. I think Netflix or any other really streaming company at all, and name any of them, would love to buy Fubo. So I think in terms of a worst case scenario, you probably got a buyout on your hands. Now, that's a risk, though, if you're looking at the stock as I am, as a potential 30+ Xer at some point down the line. That would be a potential issue. And if you really look at, what the market cap would have to be to say 30x from here, let's go ahead and plug that in the calculator. 30 times 800 million, that would be a $24 billion market cap company. That's plausible, in my personal opinion. If they do get to, 20, 30, 40, 50 million subscribers, that's a strong possibility. And that would be a small percentage of the world that would be using Fubo's services. So that's kind of the way I look at it. Risk to reward looks really good. It will look even better if the markets do fall from here. Sofi is the next stock on this list. Now, a lot of you guys probably are invested in Sofi, as I am as well. This is one of those stocks that has a really good risk to reward in my personal opinion, but if the markets do fall a lot, could also get hit quite a bit. So the stock could easily drop 50% from here. If we do go into a recession, if you do see the markets take a downturn, $4 per share would be a good target level, but I would start buying the stock a lot more if it hit that $6 range. I think it's a very good deal around $6 per share. The logic with SoFi is simple. SoFi's main business, student loan refinancing, has been shut down for multiple years. And SoFi has really diversified and strengthened the business. SoFi has been growing over 50% every single year, is adding clients like nobody's business. SoFi's deposits, even through the banking crisis, were growing at over $2 billion a week. That's insane. During the height of the banking crisis, when SoFi offered you $2 million of protection on your money via different banking outlets, SoFi gained off the banking crisis when a lot of others were not. And now, starting in October, SoFi's, which used to be largest segment of their business, student loan refinancing, should be coming back full steam ahead. This is a major catalyst we've been waiting on for literally years that kept getting delayed. So I do think it's one of those situations where the markets are not appreciating SoFi's upcoming business that we're going to see after October and throughout the next couple of years with student loan refinancing. And now the only difference is SoFi has added a lot more members. A lot more members have student loan debt that SoFi have added, and SoFi is going to be able to cross-sell these products, and specifically student loans. SoFi is like an ecosystem. SoFi is really good at cross-selling different products. Something else that I think is really cool about SoFi is the CEO, Anthony Noto. He buys SoFi on basically every dip. He hasn't bought recently when SoFi has been above $7 per share, but he takes full advantage of the dips when they come. And let me tell you right now, there's a lot of reasons why insiders sell stock. They want to buy a boat, they got to pay taxes, their wife wants a ring, they want to go on vacation, so on and so forth. But there's one reason why an insider buys a stock, and one reason only, especially on SoFi, that really doesn't get any hype when the CEO does buy. It's not like a stock a lot of people follow as far as analysts or, CNBC or other news outlets. There's no benefit as far as hyping up the share price when Anthony Noto buys. They buy because they think the company is undervalued. And Anthony Noto has been buying a lot as of the last 2 years or so. As far as SoFi stock, SoFi is a $8.24 billion company, and they are another company that should be turning profitable at some point in 2024. And once you turn profitable, you get a little bit more respect on Wall Street. So that is hopefully going to be a good time for SoFi stock. As far as this one, it is 15.56% of the portfolio, 700 shares with an average cost of $12.43. This is one that unfortunately I did not take advantage of, averaging down at $4 per share. I was too busy buying some of the other stocks that we're going to look at here next. But this is obviously one that hindsight is 2020. I wish I had bought more of. If we do get a drop back to that $4 level, I will be buying as many shares of SoFi as I possibly can. I have a market value of $6,083, currently down 30.11%, down about $2,620. The next stock on this list is Crocs. Now, Crocs is at almost $88 here. Now, this one might take you guys by a little bit of surprise. Crocs has done well over the past couple of years. Even more recently, it was around $150 per share back in April and has really fallen dramatically since then, when in all reality, Crocs is another company that has been growing 30+% over the past couple of years, aka why the stock has performed well, even from the pre-pandemic high of $40. I mean, you're still up over 100% from that. So you've still seen some good returns, but this is one where I think has the lowest potential return over time. 5 to 10x is still what I would deem appropriate. Some of these other stocks could obviously see much larger returns. SoFi is one of those too where I could see 10x, 15, 20x in due time. But I mean, that's another one that's kind of pushing it as far as anything over like a 10 to 15x. Crocs, same story here. Now, question is, does Crocs turn into a brand like a Nike? Is Crocs able to do just different things and have people willing to buy their products? Now, Crocs has been successful, but the reason I actually invested in this one is Hey Dudes. Now, Hey Dudes are just a shoe I started to see a lot of people wear, and I think that can turn into a brand in and of itself. And really, the bottom line to Crocs is it's super, super cheap. Crocs has a price to earnings ratio of 8.22. Next year's numbers are around 6. So it's not an expensive company by any means. It's trading at 3 times less than the S&P 500. For a company that's growing 30%, that doesn't make too much sense to me at all. Now, this is 11.25% of my portfolio. Average cost of $94.36. 50 shares with a market value of $4,400. And I'm currently down about 6.79%, about $320. This is one of those positions where I don't want to buy it now because I do think it could fall more if we do go through a cyclical downturn in the markets. If the economy gets weak, well, it's probably not going to do all too well. It is a really cheap valuation, so valuation-wise, it is attractive. But I just think it's one of those that there's better alternatives to buy if the markets do come down a lot. Now, if Crocs goes back to 40, under that, I'm buying as many shares as I possibly can. That's kind of the way I'm looking at this, but this is what I would call a little bit of a safer stock than obviously Fubo or Sofi. The last stock on this list is PayPal. Now, I have been buying a lot of PayPal as of recently. PayPal is at a low that you have not seen in a very long time. PayPal is back to prices that you've seen in 2017. And PayPal's business has grown a lot since then. Venmo has grown a lot since then. Braintree is expected to grow a lot more from here. And it's, again, one of those that has a very low valuation based on what it has historically traded at. Historically, PayPal has been $30 or 30 times PE. Right? Today, it's at about 18. Next year's numbers are even lower than that, at like 12. So, I mean, in that regard, it does have a very low valuation. There's basically no chance that the company goes bankrupt. I mean, people are not just going to stop using PayPal. It's too infiltrated in people's lives. So this is by far the safest stock on this list that I think reasonably could see a move back to the, mid 150s. Maybe $200, $300 in due time. I think over the next 12, 18 months, you definitely are seeing the stock over $100 per share. The levels that we're at right now, the stock's being disrespected by Wall Street. PayPal is also getting a new CEO that starts the job here in about 2 weeks, and that could, in the short term, help to really bolster PayPal's share price. The last CEO did a good job. The business kept growing, but really just did not do things right as far as shareholder relations. They kept guiding down. They really didn't set lower expectations from the start. They just kept disappointing expectations over and over again. At some point, you just want to say, hey guys, well, we're not going to grow to what you think. Disappoint those expectations up front and then start to rebound from there. You can see the stock's been just trending down, ever since really ever, honestly. The pre-pandemic high was $123 per share. I mean, you haven't done well. You're down over 50% from there. So I think it's one of those risk to rewards with the degree of safety you get in PayPal that does make a lot of sense. Now, my position is $6,246.50. I have total loss of $3,627, down about 37%. I started buying this one in the, around the pre-pandemic high because I figured, hey, the stock was 300 pre-pandemic high. That looked like a pretty good level to buy the stock. Well, hindsight is obviously 2020. Even the valuation then looked really attractive. Now it just looks even more attractive. Now I've got my average cost down to $98.72. I own 100 shares of PayPal in this portfolio, and that is 16% of the total portfolio. And the reason why this amount is so high relative to some of the other ones is the degree of sheer safety that you are getting in this stock. So just to get back to a place of break even, I've put about $10,000 into PayPal, which this is my largest position in this portfolio. So again, it's one of those, it's not going anywhere. It's going to grow consistently, 5 to 10%. If it gets anything higher than that, well, Wall Street has a lot of opening their eyes to do, and I think the share price would do very well at that point. And that's a huge possibility, right? This new CEO could totally change the game for PayPal, or it could be another CEO that basically does nothing. But I think the risk to return looks really good here. Now, I have enough risky positions in my portfolio. I want to build at least 1 or 2 or 3 positions that are beaten down, that are relatively safe. Again, Fubo, Crocs, Sofi, PayPal. These companies all have good balance sheets, low amount of debt, either profitable or going to turn a profit here in this next year. I don't want a stock that is not going to be profitable for the foreseeable future. I want a stock that's going to be profitable in 2024 that is either a well-known name and a low valuation, or, I mean, if you want to go the YOLO route, you take a very small amount of your portfolio and do that. These are not YOLO stocks. These are stocks I have a very high degree of confidence in, unless, I mean, you were to go into a Great Depression, then obviously all bets are off and we would have to remake this video completely. But I don't think that's going to happen here right now. So this is kind of what I'm doing right now. I do think there's downside here in the markets the next couple of weeks. I think at the very minimum, the second half of 2024 should be a really good time for these stocks. Now, something else I want to leave you off with is this. The Russell 2000 is still down about 23% from its all-time highs. The S&P is down about 5% from all-time highs. The Russell has really fallen a lot recently, about 8%, whereas the S&P has fallen about 3% from all-time highs. You're starting to get signs of more weakness to come here in the markets. And I think if you do get a recession, if you do get a period of down kind of growth in the economy, your Russell 2000 stocks, they're not going to do well at first, but investors will want to seek out growth. That's why growth typically does well, or growth stocks typically do well when the economy is not doing well, because growth investors, they need growth from somewhere. Let me tell you right now, Microsoft, Google, Amazon, Apple, some of these stocks are not growing at all. Or if they are growing, it's because their margins are improving and they're seeing more EPS. Most of those stocks are not growing whatsoever. So these stocks are growing more. A PayPal is growing more than an Apple is, but the degree of safety you get in Apple compared to PayPal, and just the execution problems PayPal has seen compared to Apple, well, that's why there's such a differential in these stocks, as well as the market weighting in some of those big tech names. There's a lot of nuances here, but long story short, at some point in 2024, if growth does slow down and we do head into a mild recession, these IWM, this is looking at the IWM small caps, these small caps should start to perform very well. And the up move could be, 2 to 5x in some of these names, or more over the long term, 10, 20, 30, 40, 50x in some cases is possible. But in Apple, you're not looking at any type of return even close to these stocks. So let's wrap this up. What am I looking for here? What should you be looking for in your portfolio if stocks do fall? Obviously, you want to have a set of stocks that is the beta of the portfolio, right? To somewhat mirror what the markets are going to do. You don't want to completely miss out if big tech does well, or if value stocks or dividend stocks do well. You want to have your core group. It's called the alpha. That is the other part of your portfolio that is not weighted to an index or weighted to your big tech stocks. These are your alpha stocks that can give you that extra return on top of what the markets already are going to give you. So look up beta, look up alpha. We're talking about the alpha here. You want alpha stocks that are not bankruptcy concerns, that are household names. All of these names are household names. You have heard about these names. Just even if you're not in the markets, ask anyone what Sofi, Fubo, Crocs, or PayPal is. Odds are 8 out of 10 individuals are going to know what all 4 of those are. Those are stocks they want to own. Stocks that are either profitable now with low valuations, or stocks that are low valuations still, is Sofi and Fubo, that will be turning profitable in 2024. So let me know what you think about this video down below in the comment section. Do you want more videos like this? If you do, make sure to comment down below and let me know. Hit the like button and subscribe to the channel on your way out. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.